101.9 FM with me, Trevi Hammond, and that was Kwabena Kwabna's Dadiano Ma. Very powerful song. I love that song so much. That's one of the last songs in Ghana that I enjoy. Anyway, well, we get into a roundtable discussion this morning. We're having a very important conversation. Today, we're talking about the whether we're ready for capital investments. Now, in President Dramani Mahama's 2026 State of the Nation's address, that he delivered last Friday. He laid out what appears to be a shift, and he says that from economic stabilization to structural rebuilding. And we heard about credit rating upgrades, reserve accumulation targets, procurement reforms, infrastructure expansion, and a renewed commitment to debt discipline. But the real question, especially for the business community, is whether these foundations are strong enough to unlock serious private capital. Because, ultimately, recovery is one thing, scale is another. Investors don't move on speeches. They actually move on risk pricing, policy predictability, bankable projects, and execution credibility. So this morning, we're actually interrogating the financial architecture behind the announcement. What does an improved sovereign rating truly mean for corporate borrowing? Can Ghana realistically re-enter the international capital markets? And are we even building an environment that can crowd in long-term private investment? And joining me for this conversation is Dennis Brown. Dennis Brown is a financial advisory associate at Deloitte, and he joins me over the phone lines for this conversation. Hi, Dennis. Good morning.
Yeah, good morning. Ni Hammond, right?
Yes, Ni Trevi Hammond, yeah.
Ni Trevi Hammond. Okay, so Dennis is an associate director with the strategy and transactions team at Deloitte. Just a little correction.
Very helpful, very helpful. Thank you very much, Dennis, for joining us this morning for this all-important conversation. And I am sure that, as an associate director, you'll be monitoring exactly what has been going on in the economy. Maybe first of all, the president actually says that Ghana is moving from recovery to rebuilding. From where you sit, does the data support that shift?
Well, yes, I would say the data supports that we have advanced very well in terms of our recovery. But I think he was also quick to mention that we are not out of the woods yet. For an economy like ours, particularly considering the fact that the structure of the economy has not changed significantly from the Goggisbian, economy that we know, that usually brings us these headaches that we try to, manage instead of, uprooting. If the economic structure has not changed by that much, you can't really say you're out of the woods. But I guess changing the structure of an economy is something that we can look towards within the medium to long term. It's not something that would happen, within the short term. Within the short term, we'd have to manage some of these headaches. And I think in the first year of the president, he's done very well. Taking some of the, hardest decisions. For instance, things around fiscal discipline, where government is not spending. In that first year, government is holding back a lot of supplier payments to audit them, contractor payments to audit them before, they pay them. You can clearly imagine that this will not make contractors and other suppliers that have provided services and goods to government happy. But I guess it was for the greater good, just to ensure that we are not throwing money into any leaking baskets whatsoever. So it was a good thing. It slowed down activities in the economy. Some of us, felt the brunt of it because as consultants, your clients are also not buying your services because government is not really putting money in their pockets, etc. But like I said, it's for the greater good, and we've seen the data. It shows significant recovery. It shows a significantly far more stable economy than he inherited, and only hope that he pushes on from here. The next stage is really to, grow, but not just grow, but to grow in the right direction. Because
Right.
there are times where we've grown, we recorded some of the highest growth globally, but the bane is that we're just growing an economy that has very low capacity of creating quality jobs for the people, right? So that benefits just a few people, and not really job enhancing. Now we need to move in a direction where when the economy grows, it churns out quality jobs for our people, and that requires changing the structure of the economy. It's not an easy thing to do. I guess the government is looking towards the 24-hour economic policy to drive that. Implementation can bring all sorts of challenges, as we've seen historically with beautiful policies. Always issues with implementation. That's where they need some guidance and control. They need some strictness, around some of the value leakages like corruption, wastefulness of resources, etc. Once they're able to nip those things in the bud, we should make some good progress in that direction.
All right. So you agree with the president that we are not out of the woods yet. Well, I want to know. So, from what we are seeing so far, do you think it's structural or something temporary?
Well, so far I cannot say that it's structural. I already mentioned that it takes more work than we have done to change the structure of the economy. But that's something that can only happen within the medium to long term. In fact, if it happens in the medium term, it will be a brilliant performance. So yeah, medium term will be like 3 to 5 years. It will be a brilliant performance. It's more likely to even take shape in the long term. Okay,
Okay.
by pursuing targeted policies in certain selected industries and being consistent, even if it comes with some pains to certain segments of the economy.
Right.
And that's just what economic management is about. You are hardly going to take a particular decision that have that favors everybody or every component or element in the economy.
Indeed.
At a point in time, some would suffer for it, but it will be for the greater good. So far as the decision is looking at it from the perspective of it being for the greater good, then it's fine. You can take a decision that will, in the next few years, churn out a lot of jobs, but in the immediate sense, will cause some people to lose their jobs. But that is how economic management is. There's always some delicate balance,
Right.
shortchanging some aspect for the greater good of the whole. And so, if we can live through it, the political is a very difficult thing to do because our political cycle every 4 years. Are you ready when 2028 to have people go through some pains
Yeah.
because it's the right thing to do, it's a prudent thing to do? You may suffer for it politically. So let's see how it goes. It's not an easy thing, but if the government remains as disciplined as we've seen in its first year, then we are able to do that. Don't forget that almost every other government appeared to be very disciplined in their first year. I recall in 2017, when we were listening to Foriata read some of the things that they were going to do to deal with some of the debt hangovers and stuff like that, debt reprofiling and whatnot. We all hailed him, including civil society. In the ensuing years, 2018, 2019, we saw very high growth between 6 to 7% until COVID came. So it's always like that as to whether we are able to sustain it for much longer and in the right direction is what the very big next step that we need to take.
Right. That's the next step that we need to take. So very interesting. Now, talking about moving from stabilization to investability. Well, just before I come there, I just want to support what you're saying. I mean, we saw what happened with DDEP and how it cost the NPP politically.
Yeah,
And
but it
I
had to
think
be
that's
done at the
supposed to
time.
exactly. So
It
just to
had to be
support
done
what you,
other than that the economy would have collapsed.
that's true.
So you may take the right decision and
Mm,
suffer for it politically.
yeah.
Yes, that's what it is.
Yeah. Right. So just that was just to support what you were a point you were making. So yeah. So moving from stabilization, we know that from what you said, it's obvious that we haven't stabilized fully, but we've made some progress. At what point does macroeconomic stability become attractive enough for serious private capital?
I mean, when I say I didn't really suggest that we haven't stabilized enough. The term both myself and the president used that we are yet not out of the woods
Right.
because we are still managing an economy that can at any point in time throw these ailments at us.
Mm.
The issues with the structure of the economy, it is still largely import dependent. We are still
Okay.
largely exporting primary products or commodities,
Yeah.
not adding much value. So the international market is determining the price at which we will sell that. Currently, with gold, we are benefiting because the price is going up. But you see what is happening on the oil front
Yeah.
with all these bombing
US.
Iran,
Yeah.
US. We are already being told that we should brace up because we are not processing much in terms of refinery.
Okay.
Okay, so we are still primary exporters of crude oil, and when the prices misbehave, in fact, we are net importers of refined petroleum, right? So when the prices misbehave or goes up, we'll benefit by way of the crude oil that we export. But as net importers, we import far more refined petroleum. So at the end of the day, we will incur more cost than we gain. And then we'll
Mm.
begin to feel the pinch here. We'll translate into inflation because everybody uses petroleum products one way or the other. So you see, the structure of the economy either makes you resilient to some of these external shocks or not. So the issue still remains with the structure of the economy. I think
Okay.
in terms of stability, we've stabilized quite well to bring inflation down from 23% in December 2024 to 3%. If you look at the T bills, the debt market now is very favorable for borrowers because typically the T bills references inflation. So if somebody is investing in T bills, those options, they are first looking at inflation. These are like more like short-term liquidity. Am I able to compensate for inflation and have an additional margin as, let's say investors risk taking or entrepreneurial risk margin? You understand? So if inflation is at 3.8%, you are able to do T bills at 9%, 7%, as we've seen recently,
It's even
because
five
for
percent.
the investor within the short term, he compensates for that 3.8% inflation and gets more
Right.
within that 7% or 9%. So it's only when inflation comes down to this extent that you are able to see T bills behave the way it is. So anybody that wants to go into the debt market, and you see the lending rates too, they are dropping. They've dropped in excess of more than maybe 35% somewhere in 2024, all the way down to some of the banks are now doing below 20%. Okay, so the debt market has become favorable for borrowers and especially those that intend to source for funding for various projects in high growth sectors and industries. The borrowing has become cheaper. It can go
Mm.
down further. There are some other risk margins, that are being built into the price. Something that I've written an article on that. If you look at the extent to which Bank of Ghana's monetary policy rate has dropped, the lending rate has not dropped by that much. There's something sustaining it, a
Yeah.
bit further up than it would have potentially dropped. And that's the risk margin that the lenders are pricing into it. So they are looking at the projects, they are looking at the customer, the borrower itself, they are looking at industry specific risk and pricing all of that in, because there's a base rate and then there's what else the lender looks at to then determine what margin to add on. And we've seen the risk margin rather increase over the
Mm.
period throughout 2025, although the base rate has dropped, the monetary policy rate, which influences the base rate, has dropped. The interbank rate has also dropped. We see that the risk margin, is increasing, which is something that we have recommended that Bank of Ghana does some type of research with the lenders to understand what their issues are. What are the things that are triggering these higher risk margins? If it can be addressed, then it means borrowing costs can go down further. Overall cost of capital will become cheaper. People can get funds, cheaper funds to invest in their projects and in high growth sectors of the economy to, boost productivity and generate the jobs that we need. Also, to keep fit with the journey of changing the structure of the economy. We want to be more export driven. We want to be more, it starts with being more productive in the first place. If you are not productive, you rely on the international market or global market. You import a lot of the things that you consume. But if you can rework it so that you have cheaper funds to produce some of the things that you can produce here, That is, the discussion that we'll be having around import substitution. So you get to substitute your imports with local production. Okay,
Yeah.
that's where it starts from. So we reduce the pressure on imports, which even makes forex available because then you're not depleting your foreign reserves by as much as you used to. And then we can go to the very next step of checking if we are able to produce even more to have excess to then export.
Okay.
And it's not everything that we produce here that we must consume. We may not like everything we produce here, but so far as the environment is structured to be able to produce some of the things that other markets want, we can take advantage and drive exports to those markets. In the long term, we want to be an export-driven economy, which is one that is able to sustainably generate the needed reserves that we've been talking about, and also will be able to generate jobs, keep inflation low because you are taking out all this imported inflation, be resilient to what's happening in the international market, as against what we are experiencing now. So that's the goal in the long term, and we hope we will be able to achieve that.
Right. So, is that to say that stability has been sustained enough for investors
Yes,
to trust it?
yes. So, I mean, if you look at what happened in a whole year, all the key metrics that speaks to stability are improving significantly.
Okay.
I mean, you can interrogate some of them. There's been issues or talk of the exchange rate being artificially induced by the interventions of Bank of Ghana,
Ghana. Yeah.
right? I mean, people can have different views about it, but my view of that in particular is that Bank of Ghana is also a player in the market. Aside being a regulator, is also a player in the market.
Yeah.
And as part of their mandate, they exist to intervene when they need to. So Bank of Ghana cannot be sitting on this much reserves, and there's the need for us to, reconfigure our economy in a certain way, and they can influence that and do nothing. Then what would be the essence of building the reserves in the first place? It's to absorb some of these shocks. But the advice always is for Bank of Ghana to ensure it is doing that in a sustainable manner. So you are doing that within the context where you are not significantly depleting your reserves, because then you may not be able to continue for the long term, right?
Right.
So if you look at your reserves and there's a sustainable way of replenishing what you deplete, as we've done in the 2025, because of the happenings in the international market relating to gold primary. We are gold producers. The price have been going up. Demand is high. Suppliers, which means the producers, are also gingered because they see, an opportunity to cash it.
Yeah.
So we've been able to build the reserve significantly and sustainably over the last 1 year or so. So if you look at it in that context, the reserves has been building up. If there's the need for Bank of Ghana to intervene, I don't see anything wrong with it, given that context. But assuming we are dealing with, 1 month of import cover and it's very difficult to replenish, and Bank of Ghana is, pumping in that money in there, it's just a
Yeah.
matter of time before it's like suppressing something that
It's
is
bound to
like a
happen.
spring in nature. It's just a matter of time. You lift your hand, it will spring up again.
Yeah.
So the question is not really whether Bank of Ghana should intervene or not. It is whether we are in a position where it is able to, on the way that is doing it, can be said to be sustainable.
Right.
Look at the rate at which we are replenishing whatever that we are depleting.
Okay.
So that's about it.
All
It
right.
looks like we built enough reserves. Bank of Ghana has intervened when they have to. The exchange rates have come down. It has even impacted on inflation positively because there's a component of the inflation that we call imported inflation. It comes through the dollar angle.
Yeah.
Once exchange rates are going up, the imports that we do, it translates, all of that translates. So you can see I was talking about the metrics, all the metrics that speaks to stability have been improving significantly over the last 1 year. So if you ask me as it is now, whether our economy is attractive enough, yes, I would say it's attractive enough compared to most within the
Okay.
sub region. right? Inflation now at 3.8%. And it's not just even a point matter, it's a period trend, like a trend over a
A
period.
period.
If
Okay.
consistent decline of inflation for 30 months, it
Mm,
tells you that there's something positive happening.
right.
Okay. Interest rates dropping consistently, lending rates dropping consistently,
Mm,
cost of capital, reducing consistently. So it has stabilized well enough for us to be able to attract, private capital, as you put it, or private investors.
right.
Maybe the next thing is for government to ensure that this is not lost on us in terms of the communication, right? To
Mm,
make sure we appear in certain, key sectors or spaces. Let me call it spaces where those investors are, or where we have these capital available or investable capital, and be able to tell our story, in terms of how well we've done and where we intend to go. Because it's not just about how well we've done, but to be able to put the policies in front of them that look, these are the next big steps for us,
mm.
and we expect to be able to sustain this over the next 3 to 4 years, and then we should be able to attract private capital.
Private capital. Right. Okay. We're going to look at the international capital markets shortly. And I think to support all the things you've been talking about, I mean, we've seen some ratings from Fitch, from S&P, and Moody's, and all of that, all upgrading us. And I think that is to support what you're saying. But I think President Mama also mentioned all of those things, right?
Mm, yeah.
Yeah. Okay. Please hold on for me. Let me just announce the phone lines in case somebody is listening to us and they may want to be a part of this conversation. Well, if you just tuned in, this is Business Breakfast on Z101.9 FM. And this morning, I'm talking with Dennis Brown. Dennis Brown is with Deloitte, and he is helping us make sense of the topic at hand. This morning, we are discussing whether we are really ready as a country. I mean, whether our fundamentals actually support, our foundations actually are strong enough to unlock serious private capital. And there are a lot of things we want to touch on this morning. We'll talk about infrastructure and private investment. We'll also talk about our debt and fiscal discipline. We'll probably touch on domestic capital, and then maybe policy and governance as well before we wrap up. But you're free to join the conversation. You can send us a WhatsApp on 0544321019, 0544321019, and I'll read your messages for you. That's a WhatsApp number. You can also call us on 030395664, 030395664, and then we'll give you the opportunity to make your comments or ask your questions as well. You can call us on that number. And also, we're streaming live on Facebook at ZFMGH and on YouTube at Z Multimedia. Please drop a comment under the live stream and we'll read them for you as well. All right, Dennis, let's continue the conversation. And I want us to turn our attention to international capital markets now. Now, Ghana has been largely absent from the Eurobond market. Can we realistically expect a return soon?
Well, we are in a much more favorable position than we were maybe a year ago, right?
Mm.
And so, if you look at recent happenings relating to what the international credit rating agencies are saying about our economy, we can go if we want to. But it's not just a matter of going because the doors have been open.
Open, right.
We have to take prudent decisions. Do we really need to go?
Mm.
Or perhaps we need to manage things the way they are now for a while till we are even much stronger, before we go. Mind you, my main concern would be that we are still not, what's the word? We are still not as resilient as we would like to be, especially when it comes to externalities, right? When it comes to externalities, still we are running an economic structure where, for instance, what is happening now
We're
in
vulnerable.
Israel, Iran, we are already being warned
Yeah.
that we should brace up for increasing petroleum product price of petroleum products, which could, upsurge inflation again.
Right.
Okay, so we have to put all of this in context and ensure that if we have to go out there, because when you go out there, in the international capital market, your loans are likely to be indexed in USD, for instance,
Yeah.
right? And if you run a structure where any sort of major happening out there can lead to depreciation of your CD, mhm, you're already going to face, repayment risk, where you borrowed at a certain rate, but after that, the forex rate has moved up, or your currency has depreciated, and it has increased your repayment rate significantly. And all of a sudden, these same international credit rating agencies will look at that and say the capacity to repay these loans have reduced, so you need to be downgraded.
Okay.
Yeah. So we have to be very prudent and also very timely if we want to go to the international market. My suggestion would be that we build enough reserves, okay, before we go there. And if we can, we should make some notable progress with regards to, changing the structure of our economy, okay.
Okay.
And of course, I've already said that within the short term, we can't do much about that, but at least we can set the processes in place towards that journey where we, for instance, are aiming to become an export driven economy. That gives you a more sustainable position when it comes to generating and building up your FX reserves, for instance, right?
Yeah.
Then you are in a solid position. If anything happens on the international market, you are probably able to hold on for a year or two because you built so much, reserves. And that such a thing is not likely to continue for that long. So, by the time it corrects itself, you would have had enough to hold your position safe and sound, and to still be on track, rather than the position where within a space of just say 1 or 2 months something happening, then there's only a lag period of 1 or 2 months and before you start suffering. So it's not just a case of gaining improved ratings and therefore the floodgates have been opened,
Open
just
and
go
just
and
go.
cash in. You have to be careful.
Right.
You are not going to acquire certain risks that will come and bite you later on.
Right. So
But
it's
if it has to do with whether we can go now, we can go now because we've been upgraded to a status that the
allows us
international
to do
market will
that.
look at us favorably. When you see the IMF reports too, they also back the improvements that we've had. So yeah, that's the situation.
Right. So if we want to go now, we can go. But of course, we need to have need of the funds that will come from that market before we get into the those places. Right. Okay. But maybe so you were talking about timeliness, that we must also make sure that it is time. I mean, we are timing the entire market. I've forgotten exactly how you put it,
Yeah,
but
I said timeliness is
yes,
important. That's in the context that, like, it's the same thing I said. Like, the fact that it's open now doesn't mean we should
we
enter
should
now.
go there. Right.
So we must look at our current situation, see if there's opportunity to strengthen further, right? Maybe
Right.
build more reserves, okay, before going. So we must go at a time where we know we've really covered our backs. We are not really standing on thin ice. You understand what I'm saying?
Yeah.
Uh-huh. So that's what I mean by the
The
timeliness.
timeliness.
We,
So
yeah,
is there a risk of, or what exactly are the risks of re-entering too early?
yeah. So if you enter too early, you could be entering at a time where you haven't built enough reserves. So if anything, if there is any major shock internationally, right, major external shock, right,
Yeah.
looking at the structure of our economy, still largely import dependent. Something can happen in your, for instance, gold prices. If we wake up tomorrow and the prices have started dropping giddy giddy, all of a sudden our reserves will start depleting
Depleting.
because
Right.
mine is linked to, gold. And if that happens, this is primarily what has supported our city. Our city will also begin to depreciate. Okay,
Yeah.
there are other international happenings that can also cause the city to depreciate. For instance, one of the things we benefited from in 2025 was US China shenanigans, right?
Yeah.
Where they were throwing things at each other.
The trade
China
war.
at some point decided that I hold so much US bonds, right? I'm going to offload it.
Mm.
Once they offloaded, the US dollar began to lose value. And so all major trading currencies that are referencing the dollar began to gain. They began to appreciate. It's like a mirror effect, right?
Yeah.
So you trade with this currency, and when it start dropping, you also begin to feel like it's stronger. So it's not, part of it is not down to any specific policy per se. We're just gaining from, some two elephants fighting. Yeah, the reverse could be the case. If the dollar strengthens so much, we begin to feel the city depreciating, in that regard. So a lot of the things now currently is not in our hands because of the structure of our economy. The only thing that we can do now is to cash in on the reserves because of the way gold is behaving
Mm.
currently.
Right.
So, you know, these are all risks. There are certain risks internationally that we can do nothing about except to, like I said, build reserves, build shock absorbers, right? Not only reserves in terms of FX, in terms of these other commodities. For instance, I'm talking about oil, assuming we can fix, we have fixed the toll, I understand, right?
Yeah.
Assuming we can fast track the processing of refined petroleum products, right? We'll
Mm.
probably get to channel our crude oil there and refine a lot to build our reserves of refined petroleum products, right?
Yeah.
So as this war thing goes on, we may be able to sustain ourselves for
Exactly.
maybe
We
a
can
year.
cushion ourselves. Yeah.
You understand?
Mm.
So we would have built some shock absorbers against that externality. Okay.
Mm.
So these are all risk, but I guess there are measures we can take to mitigate against these risks. To go into the international market, I already mentioned that your loans will be indexed in USD, all these euro bonds and stuff like that, right?
Yeah.
They'll be indexed in USD. Now, when the loans are indexed in USD, you'll be required to repay in USD, which means whatever activity that you channel the money to should ordinarily be able to generate enough USD inflows to pay the loan. That is the ideal hedge, or what you call the perfect hedge, right?
Mm. Yeah.
So if I get the money, I put it in projects that by itself will generate USD cash inflows, I'll be able to pay the loan easily. But we know that these loans, the way we've done it in the past, I don't know what the government will do going forward, would it can be Eurobond, but it's used for many various things. Some of
Other
it are not
things.
even capital expenditure. It could even be for current expenditure that is
Yeah.
not even bringing anything because we have need for it there and then. We
Mm.
have expenses to take care of.
Right.
Okay, so we tend to be not very disciplined because the demand is so high. Every sector is calling on government to do one thing or the other, and a chunk of
Mm.
it may end up going into recurrent expenditure, which doesn't generate anything.
Anything at the end of the
Okay,
day.
so if you have an economy like that, going into the international market in itself is a risk because you go and borrow in USD, you may end up spending in ways that will not bring the money back. And then when you spend in capital projects, it may be in projects that may not be able to generate the inflows in USD or
Mm.
sufficiently enough for you to be able to pay.
To pay. Right.
Okay, so you are always having to put pressure on, which is my find dollars from somewhere to pay. So there's always pressure, and then your CD will be depreciating as those pressures come.
Mm. Okay. Right.
It will translate into inflation as the CD depreciates as well.
Yeah, that's true.
So these risks are there.
There's a ripple effect at the end of the
There's
day.
a risk.
Okay. Right. So the so if we decide that, okay, we'll not go into Eurobond, which other external funding routes would make sense? Is it maybe multilateral support or something?
I mean, yeah, we have multilateral support with all these countries that we call our development partners.
Mm.
Um, those ones typically will come at concessionary rates. So Eurobond might be commercial, right? Just strictly what the international credit rating agencies are saying and what it then translates into the interest rate that you get and all of that, a bit more commercial.
Mm.
But the multilaterals, is based on relationship, right? Diplomacy, whatnot. and so you might get it at very concessionary rates, which is good. But let's not forget that there can also be very stringent conditions attached to these multilateral loans.
True.
Everybody geopolitically have their interest. Every country have their interest. There's nobody giving you free lunch anywhere.
Right.
No, 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 no. Nobody is giving you free lunch. If China gives you money, say, oh, this is free money. Those money comes with conditions. Maybe the politicians don't
No,
tell
they
us
don't tell
all
us.
the
Yes, that's
conditions
true.
behind it, but they come with conditions. Okay, I'll give you this for free, but I want you to make space here for me. I want you to give these contracts to my Chinese contractors. Those contracts could have gone to Ghanaian
Ghanaian
contractors
interests. Yeah.
to, even pump back into the economy, which is what we want, right? So everybody have their interest. You go the multilateral way, you might get concessionary rates, but it may come with certain conditions that if you are not able to manage well, will create even more problems, for you.
Right. How about
So,
diaspora bonds or maybe private placements?
yes, we've had diaspora bonds. I've worked in well in some other places. I think Nigeria is a name that comes up. That's something that can be explored, right? So the diasporans are, well, at least I thought of mainly being Ghanaians that are out there,
Out
right?
there.
They spend maybe the majority of their time out there, or they are engaged in one economic activity or the other out there. They have liquidity, are looking for channels to, invest them, and they'll be happy if you present the business case to them or the economic case to them to invest in our economy. Because most of these guys, value where they come from. Some of them have plans of retiring to their home country, etc. So these are some of the qualitative factors that we can leverage to get them to be interested in investing in such, bonds. So
Right.
that's a new area. It can be explored, to see what the reactions will be from the diasporan community. A lot of them are coming here and actually investing in the real sector, doing businesses, developing real estate projects, etc. A good number of them we see on YouTube, they are into farming and
Yeah.
whatnot.
Yeah.
So they're already investing. So I want to believe that if government can put together the case, right, the business case, or maybe because economic matters, let me call it economic case, right, of what they are trying to achieve and why it will be good for them to invest in. I'm sure it's something that they can buy in, and it will be, far better than dealing with sovereigns, you know, at the multilateral level that will come with conditions that by the time you yield to those conditions, you are basically, breaking your economy down, or you are, stampeding growth in a way, or you are transferring value from your own economy to other economies and creating jobs in other places just because of one small money that you,
That you get.
get.
All right. Okay. I want us to talk about infrastructure. Our time is almost up. We still have
Mm.
some few things to touch on before we go. Let's talk about infrastructure. Now, if I mean, you follow the president's address, infrastructure was a major highlight for. I mean, throughout. What makes an infrastructure project truly bankable? Maybe we can start from there.
Oh, I mean, there are a lot of factors to consider. So when you say bankable, I guess from the perspective of a private sector,
Investor. Yeah.
investor,
Yeah.
of course, a private sector simply wants to be assured that within a certain a given bounded time period, they are able to recover their money,
Their money.
and not just recover their money in face value terms, be able to recover in a way that compensates for inflation over time and also compensate them for entrepreneurial risk margin. Because you don't put your money in something and wait till at a certain time, then you take that money and the value is the same as what it was when you put it in there. Then, it's like a useless venture. You would have kept that money anyway. So to compensate for inflation over time, but also to compensate them for taking that risk,
Yeah.
which we all do business. When we do business, we want to be compensated via profits. Okay. So cardinally, for the project to be able to generate, enough cash flows over time to repay their investment and to compensate them a bit more for, if you like, profits.
Right.
Yeah, that is cardinally what makes an infrastructure project bankable. Now, there are other things that you can extend from that. As in adjoining factors. For instance, that the feasibility study shows that this will be achieved. That okay, cash flows will be generated over time, and you'll be paid. You recover your money in good measure over the period. It's not the only thing. There has to be, for instance, security, right? So yes, the feasibility shows that this is what is like. This is what the project will be able to generate. That's capacity. But in the course of it, is there something that can happen that can disturb that? So
Yeah.
let's say I'm in partnership with government. Where are the guarantees? How is government providing me that comfort? What I call security. That look, should something happen, yeah, you are safe. I will reimburse you for whatever that you are investing in. That's another way private sector thinks, especially when they are delivering projects where government is involved, because they know government can be funny when it comes to some of these things and being disciplined. They know the economy is still a bit fragile
Yeah.
and can turn on its head and all of that. So they will need good level of comfort in that regard. That look, when I put the money in there, the project studies or feasibility studies um suggest that the project looks good, it's profitable and all of that. However, during implementation, am I assured that government is going to protect my interest, right?
Okay.
Yeah,
Right.
ensure that if something goes wrong, I'll be properly reimbursed. I have nothing to worry about. These are some other qualitative factors that
That may be
they,
looking at. Now,
they look at.
I want to know, are PPP frameworks strong enough to attract global investors?
Yeah, it all depends on the structure. It all depends on the structure. PPPs is a broad thing. It's government together with private sector delivering an infrastructure project, for instance. That's PPP. It's fine. It's just partnership. But as to whether it will attract the needed private sector funds depends on the structuring, and some of which I've touched on already broadly. That look, the private sector person wants to have comfort
Yeah.
that the project will work. And if the project doesn't work, you know, as much as its skin is in the game, there are some guarantees from government to ensure that it doesn't the thing doesn't collapse the private sector person completely. You understand?
Yeah.
So you need some guarantees that okay, I'm in this with you, government. We are implementing this together. For instance, when we finish a road project, you must have been able to assure the private sector guy that you will give him control to manage the road project, and you allow him to tow the road maybe at a certain rate or at a rate that will allow for him to recover the money over a certain
For some
period.
time. Yeah.
That government must do with legislation, with policy and all of that is the responsibility of government. That is why the private sector will require that level of comfort from government,
Yeah.
because it's a PPP, it's a project that will be used by the public, right? But at some point it must be commercialized to bring in the needed revenue. If government begins to get political, then you are going to, you know what I mean by political. So if the political pressure comes and government begins to fear that maybe they will lose votes if they commercialize their thing, they ask people to pay toll and all that, political opponents will milk it. Okay, and
Yeah.
doesn't do it, then it defeats the purpose of the whole thing, because then private sector becomes exposed. Those are things that private sector will be thinking forward about. That I'm going into this arrangement with government. What are the things that government can produce that I can rely on? It's a strong backing, whether a pre-agreement or some type that says that this policy or legislation will be passed to ensure that I'm able to manage this project in this manner so that I can recover my investment. For the private sector, it's mainly about recovering their
Yeah.
investment
Yeah.
plus more. So the very things that must be done, some of it may not be popular within the political circles. And that's a major risk for PPP, as to whether governments will be able to take the difficult decisions that will make them unpopular, but at the end of the day produce a project that works for all. is the
All right.
challenge.
Okay. Our time is up. I wanted us to touch on our debt situation as well, and whether all of those things and maybe policy consistency as well. But because of our time, we would have to wrap up. Now, many reforms actually sound very good on paper, and we've seen quite a number of reforms happening. There are still some more to do. Maybe just by way of painting a particular picture, where do you think we usually break down in this country? Is it the design or execution when it comes to reforms?
Oh, the design is always almost near perfect.
Mm,
The design is almost always near perfect. So by the time you see it on paper, it really looks like something that will work. It's always the case. Where it breaks down, it's implementation,
yeah.
where we now put it to effect. So you see a lot of implementation deficiencies. If it's not corruption, you know, is merely or purely wastefulness of resources because the people that have been put in charge to implement do not really understand. They are there as political appointees sitting on resources and not getting the needed help, so they are wasting their resources. Or it could
Mm,
be corruption, let's say again, through political parties. There's a lot of food soldiers to take care of, so every project is like an opportunity to take care of food soldiers and whatnot. Somebody believes that they've invested so much in the political process. Now they have opportunity. So they are not really thinking about, all these things, grammar that you're talking about. For them, is an opportunity to, get what is due them. Okay. Or merely incompetence, or if I get or things around competence, where you just have square pegs in round holes, handling these projects and not doing what they have to do. One of the other things that we also don't do well is monitoring and evaluation during implementation. Okay, so we 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 like to measure, we like to brag, or how do I even say, we like to be loud about outcomes instead of impact.
impact, right?
Okay,
Yeah.
so somebody will say, we were to distribute fertilizer to these farmers. We have distributed 500,000. Clap for me.
Mm,
But
what has that
did you
done?
follow up to ensure that
Exactly.
that really achieved what it was set to achieve?
Mm,
That there's a reason behind it. That maybe whatever that is being produced will be refarmed and will go by a certain. So over time, we should follow up to then say, okay, this is the impact that it created. It created so many jobs, quality jobs. This translated into this level of increase of income. We've seen purchasing power improve and it's connected. We have not been able to, connect the dots in that manner. So it's just like a procurement economy. This money was allocated to do ABC. So I've thrown the money at those things. And so I come and report that I've invested this amount in this thing. And we are supposed
mm,
to be happy. But whatever you may have invested may not be achieving the needed impact.
right.
And that's where monitoring and evaluation comes in at every key point. We need to be able to, when you are monitoring and closely monitoring, you're able to pick up where there are deficiencies. For instance, there may be value leakages. There may be corrupt practices going on down the value chain. You are sitting at the top. You are not monitoring across. So you are
Mm,
just, putting the money in and it's not yielding the needed returns. But if you are
yeah.
monitoring, you catch that early. That look, there are value leakages here, let's block it. There are deficiencies here, let's block it. Down the chain, these other persons don't know what they are doing. They are wasting our resources. Let's replace them. Look, this is supposed to be the impact. When we measure it, it does not reflect. Nothing has changed down there, which means in between, somebody is not doing what they are supposed to do, or maybe
Mm,
diverting materials and goods elsewhere and stuff like that. If you are doing your monitoring evaluation properly, you get to pick up on those things early and you correct them before you waste too much resources.
right. Okay. Dennis, thank you so much. I don't know, maybe 30 seconds, if there's anything you want to put across, maybe to governments, policymakers,
Oh, I mean, to government
and the
policymakers,
business
we've seen,
community.
yes, we've seen some good level of discipline,
Mm,
fiscal discipline in particular in the first year, but that has also come at the expense of real growth, if I can put it that way.
yeah.
The next stage is to look at how we expand the economy, but not just expand the economy, but for it to grow in a way. that improve the job creation capacity of the economy. And that can only happen when we are able to change the structure of the economy. When we implement those policies that are supposed to make us an export-driven economy, that are supposed to put a import substitution policy up as a priority, right? To reduce
Yeah.
imports that are also able to help us add value to the primary products that we send out there, so we can mitigate some of the price shocks and retain a lot of the value to us. Then we'll be heading to the right direction. So for policymakers, this is the direction for us. We all know it. It's nothing novel that I'm saying, but I guess it will require discipline to implement some of the fine policies that we have on paper, like the 24-hour economic policy. It's a very brilliant policy that looks at things from a holistic point of view.
Right.
Every part that will be affected has been taken care of on paper. Now we need to ensure that we translate it on ground in a very disciplined and coordinated manner.
Right. All right, Dennis, thank you so much for your time, and thanks for sharing your insights with us. We are really, really grateful to you for your time.
Thank you. Thank you to your listeners and viewers as well.
All right, really
It's a
grateful.
pleasure.
Hopefully, we can have some more conversations in the coming days.
Okay, I mean, once we can make the time.
Definitely. Definitely. Thank you so much. All right.
Thank
So,
you.
right. So that was Dennis Brown. Dennis Brown is an associate director at Deloitte, and he joined us this morning. Talking about exactly our investment climate here in this country, whether our foundations are strong enough to attract capital investments, or to attract serious private capital really into the economy. And he's made quite a number of points, and these are all very important things that we need to pay attention to. But if you miss any part of this conversation, feel free to visit our social media platforms on Facebook, and on Facebook we're at ZFMGH, and on YouTube at Z Multimedia. You can engage us on those platforms, and we'll be very, very glad. All right, so this will be all for Business Breakfast on Z101.9 FM. Today with me, Nitra B. Hammond. We're back again tomorrow for more interesting conversations. Until then, please keep listening to Z101.9 FM. And as we celebrate and we observe this Ghana month, feel free to also eat Ghana, drink Ghana, wear Ghana, and everything Ghana. I'll see you tomorrow. Up next is The Brighter Side with Jeremy Okoria Mwako. When you think Ghana, please think Z. Bye-bye.